Markets have had a strong run year to date with the S&P 500 up about 16%. The NASDAQ up about 20%. But with those highs come some familiar concerns, valuations, volatility, and whether the rally can keep going. My next guest says markets have already seen a big sell-off, and all the uncertainty out there highlights the importance of sticking to your investment process. Ben Gossack is with TD Asset Management, and he joins me now. It is lovely to have you here.
Yeah, it's a pleasure. Thank you for having me.
I feel like that, what I just said, which came from the feedback you gave my producer, was like directed to me directly, because I know I get scared off. When you see markets so high, you just think it's too much, it's too much. So maybe just tell us a bit of what you're hearing about why people are feeling so uneasy about these market highs.
Yeah, it seems if we're at new highs, how could we go higher? We can only retrace what happened. And that seems to be what consistently is coming up in conversations as I go across Canada. But how are we supposed to get to higher highs? Once we're at these levels. So I think so much has happened this year. Just been a barrage of news and various sort of themes. And I think people forget that we already had a 20% drawdown this year. And meanwhile, everyone's expecting and waiting for the next shoe to fall. And it's, we've cleared out a lot of concern in terms of sort of policy back in spring.
Let's take a look at the chart. You, as always, thank you. You bring us lots of fascinating charts to look at. So this is a look at the S&P 500, the drawdown. And yeah, to your point, there has been a drawdown.
There was a major drawdown. So it took 33 days, so about a month, for the market to swiftly fall 21%. And then about 56 days for us to recover that high. We did have a bit of a wobble within the past 2 weeks where we did fall about 5%, and there were so many different narratives as to what was driving that. And Nvidia, delivered record earnings, but then the market sold off. So was that the end of AI, and is it a bubble? And yet now we're probably 1% off those highs. But again, if we did have a massive drawdown in a swift period because there was uncertainty about policy, and when markets got some clarity about what trade and how this administration was going to go about it, we did rally through that. But I think it's just, people have already, forgotten that, and now are waiting, well, if we're at highs, then,
it's going to happen again.
What's going to be the next pothole for the market?
Let me ask you, you were saying that you believe that some of the pullbacks we've seen weren't driven by fundamentals, to your point, but you're saying these are technical dynamics. Is this just the concerns about policy or other just uncertainty out there?
So I think markets are complicated because we have a whole bunch of people expressing their opinions, and then it all gets merged together and we get a clearing price, and that's the price of a stock, and it changes every second throughout the day. We do spend a part of our process, we love fundamentals and secular trends and understanding human behaviors, but an equal part of that process is understanding patterns. And one pattern that we keep seeing, especially in this instance of the market, is we're seeing a double top pattern. So a stock or a sector had made a high, it had come off, it attempted to make another high and rolled over, or it broke out and it failed to hold the breakout. And so people, when they see that pattern, they're like, oh, we're ready to go. Let's get all of our purchases going in. And then when that pattern doesn't hold, everyone's caught on the wrong side, and the outcome is a very vicious sell-off.
Can we bring up, because I think, again, you talk about failed breakouts. We have a chart that shows that. So maybe just let's bring it up and talk a bit about what this is.
Right. So obviously the key topic in the market is AI, and do we have a bubble, and is it Nvidia's chip, is it Google's chip, a whole bunch of stories. What people are looking at right here is the technology sector of the S&P 500, and I've taken that sector and I've divided it by the market. All that people need to understand about this chart, if the chart is going up, it means that technology has relative strength to the market. And if it's going down, it means that technology has relative weakness to the market.
Okay.
And so we have this red line, so that identifies the previous high, which happened in 2024. Tech did actually underperform for almost 10 months. Most people did not notice that. And then we actually rallied through and surpassed last year's relative high, but we failed. And so we had this vicious sell-off. It does coincide conveniently with NVIDIA delivering earnings, but that wasn't good enough for the market. And that allowed a whole host of bearish opinions to sound really credible. And they could be credible, but it's the viciousness, I think, of a failed breakout that makes those sort of bearish tones sound very credible. But yet it could have easily just been a technical sell-off, Kim.
It's interesting too, because we talk about disciplined investment process, and this isn't motherhood. This is about sometimes understanding your own behavior and how you get in your own way.
Yes, I do think prices drive sentiment. When I first started in this industry, I used to think there was a catalyst. You try to figure out what's driving the stock, and that would drive the the behavior behind a stock movement. But really, I do think prices move. And then we as humans start to build the rationale for why it happened and how we feel about that. With social media and the speed at which I'm seeing the markets move faster and faster, 1 week we're talking it's got to be this, and the next week we're flipping and we're saying it's got to be this. And I think for the average person, that sounds very contradictory. It sounds confusing, and this is why we really do preach having a process. How is it that you go about managing money? How do you think that you create value with your process? Because right now we're just getting bombarded from all sides, and that process will at least, it's sort of that compass where you're like, okay, I don't know where we are, we're in the middle of the ocean, but that compass sort of helps guide you through, because no one is really trying to help you make money. They're going to try to confuse you as much as possible.
There is no shortage of AI information out there. I feel as though I'm almost drowning in it all the time to understand what's out there. What's your take on it from your perspective? What do you pay attention to?
So there's a lot of takes. There's a lot of people providing content. They think AI is going to do this or do that. I've tried to go more glass half full. Who would have imagined we'd be going into strangers' cars in 1990, 2000 as we go through the tech bubble, right? So, the iPhone doesn't come until 2007, and that wasn't discussed back then. So I think AI can do a lot of things, and I've just been sort of taking it sort of one day at a time in terms of, how do I really think it's going to change the world? But it is having implications today in terms of stock prices and valuations.
Okay, so let's talk about that. There's been lots of different ways it does, but you've brought 4 charts of what's catching your attention. And one of these is you talk about how AI is reshaping the software world. How?
So, everyone's focused on who has the best chip and who's got the best accelerator and who's got the best fiber optic cables. And what people may not be noticing is that software has been a casualty of this AI trend. For the longest time, I used to cover technology starting in 2013. There was this moniker that software eats the world. So we may have a breakthrough in hardware. So there was an iPhone, there's the desktop computer, but all the profits ended up with the software companies because they developed the interface that provided us value. Office suites provided productivity to the enterprise. And so we may not know exactly what AI does, but we do know it codes very well.
Yeah.
And so if it can code me a tax accounting software, well, do I need to pay all those subscriptions to the major tax accounting software companies or legal software or customer relationship management? And so what right now the market is not doesn't know who the winner is and who's going to survive, and so they've decided to step away from the software sector.
And that's what we're seeing here on this chart, right? Just this fall to the right is just to say we're just not sure.
Right. So this chart is basically a tug of war between software and the S&P 500, and you see this rollover, which means imagine the S&P 500 is like really pulling software to the other side and just saying, we are not comfortable being in this space. And that, I think, is a big paradigm shift because it's been very easy from a technology investor perspective to just own software companies and avoid hardware.
Yeah, it's sobering. Okay, the other thing that's been happening, of course, is there's been so much emphasis on like the Mag 7 and chips and NVIDIA, as you mentioned, and power, which of course is powering AI. And now there's the emergence of the anti-AI trade. So what is that?
So yes, I think there have been too much emphasis on the Mag 7 and people have not counted other stocks that have outperformed. But as you said, yes, it's about power, it's about industrial. So my biggest challenge in terms of managing a US portfolio is I don't want to have a whole bunch of holdings, but they're all tied to one idea, which right now is AI.
Yep.
And AI, like you said, in the past, if I wanted to get defensive, I'd go buy a utility. Well, right now that utility is all about powering the data center. So, the old paradigm is actually going to introduce more risk when I start reaching out for these sectors that would have helped me in the past. What we are starting to see emerge right now is, yes, the market likes AI, it's exciting, but it also can introduce a lot of risk. So how do you properly add some defense to your portfolio? And we're starting to see emerge certain sectors, certain stocks where we can actually hedge that AI bet in that theme.
Let's bring up a few. The first one is healthcare.
Yes, so healthcare has been a very challenging sector. So again, if we go back to our tug of war example, healthcare has lost the tug of war to the S&P 500. This is XLV. It's an ETF that represents the healthcare sector. So you have pharma, med tech, drug distributors. They've just been losing. But we're starting to see that move because, well, there isn't a lot of AI right now in healthcare. So we're seeing pharma companies move. We're seeing medical distribution companies. It's bringing back some life to this sector that most people had, they had a lot of exposure to, but because it's underperformed, have really reduced their exposure. So there's a lot of opportunity here. And the one nice thing about healthcare, it's not like, I like banks. It doesn't matter really what bank I buy. They're all going to swim in the same direction. Every healthcare company is different. So we're seeing a move. You still have to dig in and find the right companies, but it provides some diversity for the portfolio, which is very exciting right now.
Yeah, it is important and hard to find. We've only got about 30 seconds, so I want to make sure I get the next one is biotech. So I assume the same principle here, right?
Same principle, but even harder. So they're all moving, but you really have to know your biotech company because if you miss a phase trial, it can be disastrous. Yes.
Yeah. And then finally, utilities. But interestingly, these are not North American utilities. As you mentioned to me, these are EU utilities.
Yes. So North America is all about powering the data center, whether it's going to be nuclear or gas. In Europe, that's not even part of the discussion right now. So I'd say the European utilities are still acting like that traditional utilities that most investors would be familiar with when they're wanting to add some defense to their portfolio.